Hey everyone, so let's talk about debits and credits. I know, for a lot of people, just hearing those words brings on a little bit of anxiety, right? That little knot in your stomach? Well, you're in exactly the right place because today we are going to crack this thing wide open. Seriously, by the end of this, you'll wonder why it ever felt so complicated. Ready? Let's get into it. I bet you've heard this a million times. It's like Accounting 101, day one. Your professor probably wrote it on the board. Debit on the left, credit on the right. And everyone nods. Yeah, okay, seems simple enough. But is it really?
Exactly. That's the big question. Knowing that one goes on the left side of a T account and one goes on the right, that doesn't actually help you when you're staring at a transaction. It doesn't tell you why something is a debit or why something else is a credit. And you know what? The why is the only part that actually matters.
And right there, that's the root of the whole problem. See, when all you do is memorize left and right, you're completely missing the logic underneath. So what happens? The second you're faced with a real-world transaction, that nice simple rule suddenly feels totally useless. And that's when the panic sets in. Okay, let's look at a super common example, a totally normal everyday business deal. You purchase goods for cash, let's say $1,000 worth. Simple, right? Seems straightforward enough until you have to actually record it in the books. And boom, there it is. That moment of hesitation where your brain just freezes. You're thinking, wait a minute, is cash the debit or is it the credit? And what about the purchases account? See, this is exactly where left and right completely fails you. But don't you worry, we're about to fix this for good. All right, deep breath. Welcome to the actual solution. I want you to completely forget about left and right for a second. Just wipe it from your mind. Instead, we're going to focus on one single logical rule. This is the key that unlocks everything. I'm talking about your genuine aha moment. Okay, here it is. This is the one thing you need to burn into your brain. It's not about left and right. It's about flow. Think of it like this. Debit is what comes in to the business. Credit is what goes out. That's it. What you receive is a debit, what you give is a credit. In versus out. This simple idea is the foundation for absolutely everything else. Okay, so now that we have that golden rule, we just need one more piece of the puzzle to make it all work. Before we can apply the rule, we have to know what kind of account we're looking at. Because every single transaction you'll ever see involves accounts that fit neatly into one of just three categories. And here are those three categories. That's all there are. First, you've got your personal accounts. These are for people or other companies. Then you have real accounts, which are basically your assets, tangible stuff. And finally, nominal accounts, which are all about your expenses and your income. So let's break these down. First up, personal accounts. Anytime you're dealing with a person, a customer, a supplier, even the owner of the business, that's a personal account. And the rule here is super logical. Debit the receiver, credit the giver. So whoever gets something is the debit, and whoever gives something is the credit. Next up, we have real accounts. Now, these are your assets. Think of stuff the business actually owns, like cash, inventory, equipment, buildings. And here's the cool part. The rule for real accounts is our golden rule. Debit what comes in, credit what goes out. See how it all connects? The logic is consistent. And last but not least, nominal accounts. Think of these as your performance accounts. They track how well the business is doing. So this is where you'll find your expenses, things like rent or salaries, and your income, like sales revenue. The rule here is super simple. Debit all expenses and losses, credit all income and gains. Easy, right? Okay, that's enough theory for now. The absolute best way to make this stuff stick is to see it in action. So let's take everything we've just talked about, the golden rule, the three account types, and apply it to a couple of examples. Let's see how it all clicks. All right, first example. The owner decides to start the business by putting in $10,000 in cash. So think about what's happening here. Two things are involved, right? There's the cash and there's the owner's contribution, which in accounting we call capital. So if you were to write this out, the correct entry is a debit to cash for $10,000 and a credit to capital for $10,000. But the big question is, why? Why is that the right way to do it? Let's use our new framework to figure it out. This is a perfect example of how the rules work. Let's start with cash. What type of account is it? It's an asset, so it's a real account. Now, is the cash coming in or going out? It's coming into the business. And what's our rule? Debit what comes in. Boom, done. Now for the other side, capital. That represents the owner, who is a person, so it's a personal account. Is the owner receiving or giving? The owner is giving the cash to the business. Our rule? Credit the giver. See? It just works. Okay, you ready for this? Let's go back to that transaction that caused all the panic at the beginning. Remember? Purchasing goods for $1,000 in cash. This time, though, there's going to be zero guesswork. Let's just apply the logic. And the correct entry is a debit to purchases for $1,000 and a credit to cash for $1,000. Look at that. No panic. Just simple logic. So why is that right? Let's do the breakdown. Purchases. That's an expense for the business, which makes it a nominal account. And what's the rule for expenses? You always debit them. Super easy. Okay, what about the cash? Well, cash is an asset, so that's a real account. Is it coming in or going out? It's going out of the business to pay for the goods. And our rule is credit what goes out. See, the framework just hands you the answer. So there you have it. You've got the core logic down. But the real goal is to make this feel like second nature, right? To do that, you just need a simple process to follow and maybe a couple of little tools to help it all stick. So here's your mental checklist, your toolkit. Number 1, the instant you see a transaction, your first step is always to identify the types of accounts. Is it personal, real, or nominal? Step 2, ask the golden question, what is coming in versus what is going out? And number 3, and this is the big one, practice. Seriously, even just looking at a few transactions every day will turn this whole process into a reflex. And I've got one last thing for you, a fantastic little shortcut to help you remember all this. It's a mnemonic, dead, click. So dead tells you what things are normally debits, D for drawings, E for expenses, and A for assets. Then click tells you what's normally a credit, C for capital, L for liabilities, and I for income. Dead click. It's an awesome way to just quickly double-check your work and make sure you're on the right track. So there it is, debits and credits, totally demystified. It was never really about left versus right, was it? It's all about a simple, logical flow, what comes in and what goes out. And when you use this framework, you're not just memorizing rules anymore. You're actually starting to think like an accountant. Which leaves me with just one question for you. Now that you know the rules, what other business mysteries are you ready to solve?